Hey everyone, welcome to today's Explainer. We're going to completely flip the script on how we look at the banking industry today. We're so used to just thinking of banks as, safe places to stash our savings and checking accounts. But beneath that totally calm, boring facade, there is a wildly complex, layered, profit-generating machine. Let's dive into it.
So let's just shatter this illusion right off the bat. Is a bank just a big static vault where your paycheck sits? Honestly, no way. You deposit your cash, and sure, the bank gives you this slick little app to check your balance. But the literal second your money hits that account, it does not just sit there gathering dust. It goes to work. This massive machine kicks into gear to lend, invest, package, and multiply your cash.
Okay, at the very core of this machine is basically a giant spread trade. It's called the net interest market. And all that really means is it's the gap between what a bank pays you for your deposits and what it charges other people to borrow that exact same money. This spread, this is the historic bread and butter of how banks actually churn a profit.
Let's look at the stark math here, because it's actually pretty wild when you think about it. A bank might pay you, say, roughly 0.5% a year to park your $10,000 in a savings account, right? But then they turn right around and lend that exact same money out for an auto loan or a business loan at 6, 7, maybe even 10%. They are literally borrowing low from you and lending high to someone else. It's that simple.
Now here is the magic, or the math rather, of fractional reserve banking. Step 1, you deposit your 10 grand. Step 2, the bank doesn't actually lock it all up in a vault. Historically, they only hold back a tiny fraction. Let's say 10%, so $1,000. That means step 3, they immediately lend out the remaining $9,000 to someone else. Then that person deposits the 9 grand in their bank, which holds 10%, and lends out the rest. Your one single deposit mathematically fractures and multiplies across the whole financial system.
We call this the money multiplier effect. And look, it's incredibly powerful, but it also makes the whole system inherently fragile. Because your money is out there tied up in 30-year mortgages and car loans, the bank physically does not have all that cash on hand at once. If everyone panics and asks for their money back on the same day, boom, you get a bank run. And we actually saw this real-world fragility play out recently with the rapid collapse of Silicon Valley Bank back in March of 2023.
Moving on to Section 1, the upgrades, the quiet fee stream.
So if interest is the main engine, fees are like the thousands of tiny leaks engineered into your daily financial life. We're talking account maintenance, out-of-network ATM charges, wire transfers, loan origination, you name it. But the absolute worst offender? The overdraft penalty. You could literally buy a $4 coffee, accidentally dip a penny below your balance, and smack, instant $35 penalty. A single bad week can trigger multiple penalties in one day, siphoning billions of dollars a year straight into the banking industry.
But get this, the biggest fee is actually one you might never even see. It's right around 1.5% to 3.5%. This is the invisible interchange fee banks take from merchants on literally every single debit or credit card swipe you make. The store just absorbs this cost and quietly builds it into their everyday prices. Multiply a few percentage points across billions, and I mean billions, of global transactions every year, and you've got this staggering, invisible river of cash flowing directly to the banks. The absolutely crucial takeaway here is that fees, they aren't just a side hustle anymore. They are a foundational pillar. Over the last few decades, as market competition really squeezed those interest margins we talked about, banks had to pivot. They aggressively engineered these fees so that today, non-interest income makes up almost as much of their total revenue as traditional loan interest does. It's a total game changer.
All right, Section 2, Wall Street, high-stakes investment banking.
Now we're stepping into the big leagues. Investment banks run massive operations for huge global corporations. Say a company wants to go public with an IPO. The bank underwrites the whole thing and takes a percentage cut that can easily equal hundreds of millions of dollars on just one deal. And it's the exact same story for advising on multi-billion-dollar mergers and acquisitions. They take a percentage of the deal size, basically turning corporate handshakes into absolutely staggering advisory fees.
But wait, beyond just advising, these banks also actively trade. As market makers, they literally stand ready to buy and sell stocks and bonds at any second, profiting off the tiny gap between the buy and sell price. That's the bid-ask spread. And historically, banks also traded heavily with their own money, which is called proprietary trading. Now, it's worth noting that after 2008, regulations like the Volcker Rule in the US really tried to restrict banks from aggressively gambling their own capital like that. Though, to be fair, those rules are still a point of massive, ongoing debate between regulators and the industry.
Okay, let's look at another big piece of the puzzle. AUM, or Assets Under Management. This is simply the total market value of all the investments a bank manages on behalf of really wealthy clients or massive pension funds. And this is all handled by a much quieter but hugely profitable division, wealth management.
So why do banks push so incredibly hard to get you into their advisory services once you actually have some wealth? Well, because they typically charge a steady 0.5% to 2% fee on your total portfolio every single year. A percentage fee on, say, a $500,000 portfolio is exceptionally reliable income. And here's the best part for the bank. They get paid this percentage whether the stock market is absolutely booming or completely crashing. It is practically risk-free money for them.
Next up, Section 3, the hyperdrive, securitization. So what exactly is a mortgage-backed security? Well, instead of issuing a 30-year home loan and then just sitting around slowly collecting interest for 3 decades, a bank gets creative. They transform everyday home loans into highly tradable Wall Street products. How? By bundling thousands of them together into one single massive box.
Here's exactly how it works. Step 1. The bank issues thousands of loans to normal people. Step 2. They bundle all those loans into a single security. Step 3. They sell that security to investors. But why do they go through all this trouble? Because it gets the bank immediate upfront cash back to issue even more loans. And crucially, it shifts the risk of anyone defaulting on those loans completely off the bank's books and right onto the investors.
And naturally, this brings us to a really critical historical moment. The 2008 global financial crisis serves as the permanent textbook case study in reckless securitization. When dangerous, high-risk subprime mortgages were bundled together and quietly passed off to investors as completely safe products, risk just built up invisibly in the background, until obviously the entire global system fractured. Now, securitization isn't inherently evil, it actually manages liquidity, but 2008 shows us exactly what happens when that risk-shifting mechanism goes completely unchecked.
Finally, Section 4, the bigger picture, the layered machine. There's a quote that just perfectly summarizes everything we've been unpacking today. A modern bank is not one business, it's several stacked on top of each other. And it makes sense now, right? You've got the foundation of spread trading and lending, layered with this massive empire of fees, topped off with high-stakes Wall Street trading, wealth management, and hyper-complex financial engineering. The whole shebang operates together all at once.
Now, of course, all of this operates under a vast, complicated web of regulations, like the Basel III framework. These are global capital requirements specifically designed to prevent banks from taking on economy-collapsing risks. And really, this highlights the defining tension of the whole modern banking industry. It's this constant, never-ending battle between highly engineered, aggressive profit-seeking and strict, stabilizing regulations.
So what does this all mean for us? Let's bring it all the way back to your wallet. When you look at your checking account balance on your phone, remember that your deposited paycheck isn't just a static number sitting in a vault. It is literally the vital fuel for this entire global machine. Without your deposits, the loans, the securitizations, and those massive trading desks, they simply cannot function. I think we've completely changed the way we look at banks today. They wear a calm face, but underneath, they are incredibly aggressive profit engines. So I want to leave you with a genuine question to think about the next time you look at your own bank statements. Which hidden mechanic surprised you the most today? Was it the crazy money multiplier, those invisible interchange fees, or the sheer complexities of securitization? Think about it. Keep asking questions and keep learning. Thanks for joining this explainer.